Hello and welcome. You're watching Business Today Television. I'm Sakshi Patra and this is What's Hot, our latest offering. This is a show that focuses on everything that's buzzing on the D Street. On the show today, we will first take you through the visuals at the National Stock Exchange for Lenskart getting listed. Remember, this much-awaited IPO got a massive subscription of over 28 times and you are seeing live visuals on your screens, and we can actually just get to find out what is the listing price of Lenskart. Remember, the grey market premium has crashed already by 95% already on the day of the listing. So we are actually looking to see just about a flattish listing for Lenskart at this point in time. And there you see the visuals coming in on your screens. The price band was 382 rupees to 402 rupees per share. And you can see celebratory visuals that are coming in on the stock prices listing on the stock exchanges today for Lenskart as well. Let's quickly look at what exactly is the listing price of Lenskart right now, and that will be flashing on your screens. Remember, we've seen an all across huge demand for the Lenskart IPO despite all that debate that has been underway. And you can actually see Piyush Bansal, the founder of Lenskart, right there on the screens there. Flattish listing is what we have for Lenskart at this point in time. And we also are now going to be looking at welcoming our guest on board. We are also going to be focusing on the new earnings that are coming in as well. VA Tech Wabag has come out with the earnings and we are going to be focusing on that one. Mr. Skanda Prasad Sitaraman, who is the CFO of VA Tech Wabag, is joining in now to share with us his views on the kind of earnings that the company has posted, to decode the earnings for us, as well as share an outlook going forward from here as well. Mr. Sitaraman, good to have you with us on Business Today Television. Well, you had started off this entire fiscal year with a strong note, with a strong Q1. How have you analyzed Q2 for you, how it is panned out on various parameters? What do you think has been the key driving factor behind the earnings that you posted this time, sir?
Thank you. Good morning, Sakshi. Good morning to your viewers. Thank you for having us on your show. Our mantra has been profitable growth backed by cash, and this quarter was no exception. We delivered an 18% top line with a 20% PAT growth, a growth of PAT higher than sales. We closed with a net cash positive position of over 675 crores. And we have a very, very good mix in line with our strategy, where almost 50% of the business comes from outside India, and that way cements our position as a global major. We have always said that our focus more and more will be outside India, overseas projects, industrial projects, advanced technology projects. Today, our top 5 orders in the order book are either in desalination or in advanced technology sewage treatment projects. So that way it's panned out very well. On the margin front, we remain strong in line with our guidance of 13 to 15% band of EBITDA, and we delivered over 15% of ROE, continuing with the strength from the last quarter and year. So in summary, it was a quarter that delivered on what we had promised: a 13 to 15% EBITDA, cash positive, 15% ROE, and closing with 11th consecutive quarter where we have remained cash positive. And this is the 6th consecutive year where we are net cash positive. So that way it's been a sufficiently satisfying quarter for us.
Absolutely. I wanted to ask you, as far as the order flows are concerned, Mr. Sitaraman, where are you at by the end of the first half this quarter? What was the kind of order flows that you have already received? And if you could also share with us in the same breath an outlook for the entire fiscal year. How are you expecting the order flows to pan out?
Sakshi, we have guided the investors with a 3x of our revenues to remain in our order book. And we are today much better than 3x as we speak. In the first half, we have already booked orders of close to 3,500 crores. We are a preferred bidder in orders of over 3,000 crores. So even with the 15 to 20% growth in the top line, which we have guided, you can see that our order book will be well above 16,000 crores by the end of the year, which is in line with our target. And what is going to drive that is primarily going to be the Middle East and Africa market, which we have repeatedly said has been our growth engine and will be our growth engine for the future. Even in the first half of the year, we received a large $272 million project of Yanbu desalination. Last year, we declared a $370 million consortium order at Al Hayar, which was a sewage treatment plant. So such large marquee orders are what is already in the bag, and we see much more coming through. Some of these in the preferred bidder state, some of which are under bidding and evaluation. So from an outlook perspective, it's a very robust pipeline, and we are very, very confident of continuing to perform and meet the expectations that we have set for us, the guidance that we have given in line to the investors.
Also highlight for us the kind of growth that we can now foresee for you by the end of the fiscal year on both the top line as well as on the margins front as well. You have so far maintained a 15 to 20% kind of a growth path on the top line in the medium term. Are you sticking to that? Are there any visible signs that this guidance could also be upped going forward? Also on the margins front, sir, would you be sticking to that same guideline, or are there also levers to improve that margin going forward?
I think one of the important levers of margin improvement has been the increase in O&M that we have stated. So the O&M business is a cash heavy in terms of generation of cash, asset light, very annuity business, predictable business. This is something which we are focusing on. Higher industrial, higher international will also drive up the margin. So there are enough levers to drive the margin up and maintain it in the 13 to 15 band. And the volumes will come out of large marquee projects. So we are confident of the 15 to 20% band that we have given in terms of growth. But yes, seeing the market and also the sector, this is one sector where you have more tailwinds. So the tailwinds will surely, in our opinion, help us deliver these growth targets surely. And of course, there is always an opportunity for upside, which we will keep targeting. And we are hopeful that that kind of appreciation for water keeps going up, which will also bring more business and more sustainability.
Absolutely. Mr. Sitharaman, also wanted to understand from you when it comes to the new age sectors, say for instance data centers, semiconductors, there's so much of government's focus as well as the industry focus on diversifying, expanding into these areas as well. What kind of opportunities does this really bring out for a player like you? Are you already seeing a demand uptick for clean water for such industries, and what is the kind of opportunity you are already penciling in over the next 3 to 5 years from there?
A wonderful question. Thank you for asking that. Yes, water is a social subject, but it is as much an economic subject. So we call this the future energy solution sector, which involves solar, hydrogen, compressed biogas, data centers, and semiconductors. So this is the play that we have been focusing on for the future. And I'm happy to let you know that we have already secured orders both in the solar sector for ultra pure water, and our first project on the bio-CNG, which is also the compressed biogas. So we have already kick-started and got these breakthroughs, and we will continue to build on this. This is a more decadal view for water that you'll have to take on the future energy solutions. While the mainstay will remain the social sewage treatment, desalination, effluent treatment for industries, but it is also important that economically some of these future energy solution sectors where the water demand and reliable, affordable 24/7 water, specifically for the growth that we are envisaging and the government backing that we are seeing. This is going to be a huge sector from a water perspective, and who better than us from a 100-year legacy with the experience that we have to tap this. We have a department which focuses specifically on this, which is the Special Initiatives Department, where these four sectors are targeted. We are already, as I said, into the order intake phase, where we have seen 2-3 orders already in the bag. We are already bidding for 2 or 3 more tenders, and this is going to be the more 3, 5, 10-year growth engine, along with the international engine, which will continue to go ahead. This is going to be an important component, more from a technology perspective and contributing economically to the world.
Thank you so much, Mr. Sitharaman, then for sharing with us all these highlights. I wish you all the very best for the upcoming quarters as well. And of course, we will have more opportunities to, of course, speak in a detailed fashion about your company, your vision, of course, all the levers and the drivers that you're focusing on as well. All the very best to you. Thank you so much for your time.
Thank you, Sakshi.
All right, viewers, so that you've heard it from the management of VA Tech Wabag, the kind of drivers that have been pushing forward as far as the earnings are concerned, and what newer opportunities are emerging for the company as clear visibility for the next 3, 5 and even up to 10 years kind of a growth path as well going forward. But let's now shift focus to a lot of buzz that's happening on the D Street as well as on the commodity front as well. Let's first welcome our next guest, our market master, Mr. Sudeep Bandyopadhyay, the Group Chairman of India Trade Capital, is now with us on the program. Warm welcome to you, Mr. Bandyopadhyay. Good to have you with us as always. This is for the first time we have you on our latest offering, What's Hot, a show that actually focuses on the latest buzz on the D Street, including earnings, the newer listings, IPO space, and of course everything that is ticking on the D Street as well. First up, let me take a fresh view from you as far as the markets are concerned. We are in the last week of the Q2 earnings, and earnings practically have been the driving force for the last 1.5 odd months for the markets, and of course in the last 2 weeks there has been practically no other trigger that the markets have really reacted on. How have you looked at, assessed the earnings that have gone by so far? Does it give you any kind of a promise of earnings season bottoming out now finally?
Well, Sakshi, good morning to you. I think the earnings have been much better than what generally the market was expecting. People had pretty much factored in that the Q2 earnings will be subdued for multiple reasons, including being a monsoon period, the GST, that period between GST announcement and GST actual implementation was a lull for a lot of consumption-driven stocks. So there were subdued expectations, but compared to that, I think the results have been pretty good. And in most of the cases, at least the bulk of the cases, the expectations were beaten by the corporate performances. So I'm a bit enthused, and we are definitely looking forward to Q3 and Q4, where we will really see the demand surge getting played out. Having said that, beyond corporate results, I think things have started moving in the positive direction as far as global news flow also is concerned. The kind of truce regarding the China rare earth exports have definitely helped global markets and Indian markets. We do see auto ancillaries and multiple other segments, stabilizing and picking up growth momentum post that 1-year pause in export controls being announced by China. Also, the geopolitical stress is to an extent reducing. So I would say things have been moving in the positive direction over the last couple of weeks. Of course, the challenge continues to remain the AI valuation, AI-related stock valuation, and there are a whole lot of concerns being expressed around that. Bit of correction in US market on the AI stocks did lead to some question marks and some real doubts as far as sustainability of valuations and sustainability of US markets at such higher levels. Now, US is 60% of global markets, and if there is a meltdown or there is a crash in US market caused by lack of faith in AI valuations, obviously implications of that will be felt in markets like India as well. So we have to be a bit cautious. We have to keep watching, but domestic factors, including corporate results, have been pretty good.
Okay, we will actually come to a few specifics and find out from you about the earnings upgrades and where to really look for some of those opportunities. But let's also focus on the debut stock today, Lenskart. I remember we have discussed this while the IPO was still underway, and now the first look of Lenskart still appears to be hazy. The IPO has made its debut about at a 3% discount. This is despite the fact that a 28-time subscription was seen on Lenskart as well. Now what we are also going to be understanding is that before the IPO came in, there was so much of debate that happened around whether these lofty valuations are justified or not. Thereafter, the massive subscriptions, 18 times for retail investors despite all the noise, and the listing gain is virtually missing on day one at least. Even though Piyush Bansal has himself come out and said that it still feels like day zero even after 15 years of a journey so far, and that a lot more is to be done going forward from here. Your thoughts on Lenskart's muted debut on D Street, and what should investors do? Those who had applied for the IPO got that. Those who may be looking at this in a fresh listed sphere.
Well, Sakshi, I think nobody is questioning the business model of Lenskart. Beyond innovation and expansion in India, they have successfully diversified in the overseas market. Roughly 40% of their business is coming now from international territories, and that's a very good development considering the segment they are in. And I'm sure the growth potential for the company is also significant. The only challenge always have been and still continues to be the valuation. At 100 times plus, PE multiple, 11 times sales multiple, I don't think we would be comfortable buying or recommending buying in any stock. Lenskart comes in the same space. So at such high valuation, I think there is scope for significant correction, and the stock settling at a much lower level. Only then it will be worthwhile buying or looking to buy the stock. If somebody has got an allotment, best course for them would be to book profit. Of course, it's not at a profit; it's at a discount still. But exit at an opportune time and wait for the stock's correction to pick up again from long-term perspective. I don't think the IPO valuation is sustainable with the current fundamentals. It will take quite a lot of time for Lenskart to move and justify the IPO valuation based on fundamentals. So I am very, very cautious on the valuation. The business is good, company is good, the team is good, but not the valuation.
The valuation. In fact, right ahead of the listing and the debut of Lenskart, Ambit Brokerage House also gave a sell rating on Lenskart with a target price of 337. That implied almost a 16% downside from the IPO price as well. Now remember, they also expect a 20% revenue CAGR growth over FY25 to FY28. Although they do believe that India expansion and global scale will be aiding growth, margin expansions via the operating leverage will also be there, but at the same time they are cautious again on the prices that you could be seeing, and they do see some more downside from the debut price as well as far as Lenskart is concerned. Mr. Bandyopadhyay, if I have to ask you, for any retail investor who has been looking at what's happening in the new age tech space, we've had a lot of lessons learned from the likes of Zomato, Swiggy, Paytm, Nykaa, and all of them had one key question, and that was the valuation part. How do you really justify and understand the valuations when the company has not proven its bottom line sustained growth? I mean, for Lenskart, suddenly they had turned profitable right before the IPO year, and for a long time they were still struggling. So for the retail investors who may be now looking at a lot of key dots to find out whether at what time will Lenskart finally make sense, what would you assess and tell those kind of investors what needs to be done before Lenskart actually comes into a space that you can say that yes, now it seems to be on a positive path?
Well, first of all, I think as you rightly alluded to, profitability is a key criteria for listed markets. They need to establish and demonstrate regular profitability. As you rightly said, there were one-off item which contributed to the majority of the declared profits in the last quarter. So we will not look at that too much. Let's them demonstrate profitable growth over a sustainable period, and the market will be happy with that. Also, remember, what is a PE multiple? PE multiple actually implies the expectation of growth in the stock, in the performance of the business. Now, if a company is growing at 20-30%, they can, of course, command a multiple of 30 plus, or around that level, because that's what it represents. Now, if you are growing at 20-30-40% and you are enjoying or expecting to enjoy a multiple of 100, P multiple of 100 or 100 plus, that's not sustainable. At some point of time or the other, the market will call it out, and the prices will correct and adjust. Pretty much the same thing had happened for Zomato. Look at what happened to Paytm post its listing. We have still not seen the value price at which they were offered in an IPO. We all know what happened to Paytm, where it went, and from there is a journey of recovery. They are recovering, they are establishing credible businesses with profitability, and things are moving. Same thing goes for Zomato, which is now eternal. I think at some point of time, the profitability was not in their mind. They were only focused on expansion. Now they talk about both the parameters, expansion as well as profitability. Same goes for Swiggy. Of course, Nykaa performance has been pretty good last quarter, and they are now talking about becoming EBITDA positive very soon. So I think the focus in a listed space will have to be profitable growth, and that will determine the multiple, and that will determine the valuation at which the stock will get quoted. So as far as Lenskart is concerned, I think, as I mentioned initially, it's significant distance from that space. They came out with an IPO which is 11 times sales and 100 times PE multiple, and I think they're talking about a 20% growth and 25% growth. Now that doesn't justify 100 PE multiple. We have to see somewhere a convergence between the growth and the multiple.
Okay. In fact, you did briefly talk about Nykaa. Nykaa came out with the earnings on Friday evening after the market hours. Today, the stock is up by about 3% as a reaction to the earnings that we have seen. Nykaa's consolidated net profit has jumped by 244% year on year, now coming in at 34.4 odd crore rupees. Now, remember, this is also driven by strong traction in the beauty and the fashion business. Revenue from operations has grown by 25% at 2,346 crores. EBITDA has grown by 53%. As well. What we're also given to understand is that the margins have also got lifted to 6.7% from 5.5% as well. The gross merchandise value has climbed by 30% on a year-on-year basis as well. A sharp revival in fashion and beauty business is clearly one of the key factors that are being seen. In fact, CLSA has come out with a report post Nykaa's earnings. They have an outperform rating, a target price that they have raised to 298. Is Nykaa back on track? Is the worst behind Nykaa? How would you assess this one, Mr. Bandyopadhyay?
I would think so, because I think they have definitely demonstrated this quarter numbers that they are back on growth track, and they're also focused on profitability. They are also talking about sustainable profitability going forward, so which is a very good trend, and definitely this deserves a thumbs up. Very interestingly, if you look at what is happening in Trent on the other side, they also came with numbers, Shakshi. And the growth was much below the market expectation, much below what they have been guiding for. Now, that is a classic case of valuation not in line with the growth. And that's why probably you will see Trent correcting significantly from where it was. The expectation, if you set the market expectation of a 25% growth and you end up with 20%, obviously you will have a problem. On the other hand, the market was not expecting this kind of numbers from Nykaa, and they came with the kind of numbers which demonstrated that they are on a path to profitability and path to sustainable profitability. So the market is rewarding and the valuation is moving up. And that's pretty much the story for listed markets.
Absolutely. Nykaa, in the meanwhile, has already moved up 25% in the last 3 months. Today itself, it's up by about 4.4 odd percent there. So I hope this has given a lot of our viewers a clarity on as to how to look at these new age tech stocks as well. The other aspect that we are going to shift focus to, Mr. Bandyopadhyay, is something that the SEBI has mentioned, and that's on the yellow metal, gold. Now, this has been an asset class that has been clearly the top of mind asset class for all retail investors all through last 1.5 years odd, because it has widely outperformed the stock markets and their performance. And even now the prices have not really climbed down as much as how we would want to see after a huge run up. Now, the fresh warning that has actually come from the capital markets regulator SEBI is with respect to digital gold. And SEBI has now cautioned investors against digital gold or e-gold that are sold on online platforms, a lot of apps, saying that these products are not regulated by SEBI. Such offerings, SEBI has said, are marketed as alternatives to physical gold. SEBI has clarified that digital gold on platforms does not follow under SEBI's regulatory framework. No investor protection is available for such products, and investors could face counterparty and operational risks there. Now, SEBI has also pointed out to gold ETFs via mutual funds, electronic gold receipts that are tradable on stock exchanges, exchange-traded commodity derivatives linked to gold. These can be bought only through SEBI-registered intermediaries, is what SEBI has marked out. Let's actually try to assess what's happening here. Mr. Bandyopadhyay, first, for clarification to all our viewers out there, what does the SEBI warning imply on? What kind of platforms should one be wary of which are dealing in digital or e-gold? Because there is a lot of uptick in gold ETF purchases via mutual funds. Is that still a safe space vis-a-vis all the e-gold as alternative to physical gold? How are you helping our viewers to understand where exactly is the problem?
I think the SEBI's this warning is very, very timely. We all know there is a euphoria around gold. The gold prices are moving up. Retail is very keen on investing through the gold, and rightly so. So there is absolutely no problem in that. And asset diversification is definitely needed. Some amount of your money should be in gold. There's no doubt about that. Now the question comes, who are you trusting with your digital gold? When you buy physical gold, you go to a recognized jeweler and buy the gold. That's understandable. But when you are buying digital gold, you have to be definitely careful about what form you are buying. As you rightly said, mutual fund ETFs, which provide digital gold in a form, is definitely well regulated by SEBI and can be trusted. There is absolutely no problem. The government of India comes out with gold bonds, and I think that's a very, very good way of investing in gold as and when and if they come up with these kind of gold bond issuance. Apart from that, I think there are multiple unregulated digital gold service providers. Now there you have to be extremely, extremely careful, because these, as SEBI rightly saying, these are not regulated entities, and the credit worthiness, trustability of these schemes and these gold, digital gold, stock is absolutely questionable. So investors will do well to avoid, these kind of service providers who are not regulated by anybody. I would rather, people invest through mutual fund route, where there are gold ETFs available, and they can gold silver ETFs. They can do that. They want to be cautious. I think there is multi-asset allocation fund of mutual fund houses which allocates between equity, bond and commodities, that is gold, silver, etc. That can be used. I think there are multiple ways to invest in gold in a structured manner which are regulated, and investors will do well to choose those options rather than going for these unregulated platforms.
Fantastic. I hope this has given enough and more clarity to all our viewers. You have to be very careful with who you're trusting with your gold, like Mr. Bandyopadhyay has pointed out. Remember, all the listed, mutual funds that actually come under the ambit of SEBI, and if you are actually going through your investments in gold ETFs via them, that's absolutely safe. But any unregulated apps that say that yes, whatever you pay in terms of earning digital gold is equivalent to physical gold, well, be very careful with that as well. Many thanks to you, Mr. Bandyopadhyay. As always, it's always a pleasure to listen to your wonderful insights across the board on investments in markets, on IPOs as well as gold now. This has given a 360-degree view to all our viewers, and always appreciate your wonderful insights, sir.
Thank you.
All right, thank you so much. Viewers, we will now wrap up this special edition of What's Hot right here, from Lenskart IPO to earnings, kind of an understanding that we've given you in terms of the new age companies, as well as on gold, the SEBI latest warnings that have come in. We have actually covered all the buzz that you need to know this morning on What's Hot and on Business Today Television. Market coverage will continue on the other side, so stay tuned with us. And in case you have any questions about the stocks in your portfolio, ask them away on Daily Calls show at 12 noon, where market experts will actually help you define your own strategy on the stocks in your portfolio. Stay tuned for that too.
Each winter, Delhi slips beneath a toxic haze, a crisis so predictable it's become part of the city's calendar.